So how do we do this? Introduce a term here called the lazy 1031 exchange. And this is what exactly I did when I sold 7 of my rental properties in 2016 and I was moving into syndications and private placements. Now that year, I had a depreciation recapture capital gain of $250,000. I do believe majority of that was with the capital gains, but again, like we said in the last section, you got to add in that depreciation recapture here to get the full number. But I didn't pay taxes on any of that because I had been investing in syndications and private placements and other real estate that allowed me to pocket passive losses and use it when I needed it, in this case, in 2017. Now, to break that down, when you are able to pull depreciation out of an asset, it is called a passive loss, a passive activity loss, or what we call PAL for short, because there are PALs. Now, you can choose to use that on your taxes to offset other passive income. Or if you don't have passive income to negate, or you don't want to negate it and you rather just pay the taxes on that, and that's cool. And that sometimes that makes sense, you can pocket these passive losses and they will become what is called suspended passive losses. Now, you may have a lot of suspended passive losses on your record. You can go to the 8582 form and see how much suspended passive losses you have on your side built up. You may even have enough to not even worry about taxes. Now, I will give a little bit of warning here. Your CPA may not give you your 8582 form. Why? Because it's built up in the code of their tax filing software. And a lot of these guys, they don't like to give it to you because that's how they know you're going to run to another CPA. Maybe another one that we recommend that's actually cheaper and better. If you guys need a tax referral, you can shoot us an email, team@thewealthelevator.com. So going back to my situation, that year when I sold off all those rental properties and I had a $250,000 capital gain and depreciation recapture on my 8582 form, had all these suspended passive losses built up. I must have had at least half a million to maybe even a million at the time that I was able to pull those suspended passive losses in a way, pulling from the cloud, and I was able to use them on those taxes that year. Of course, at that point, those suspended passive losses goes away. Can't use them anymore. So this move that I just pulled off, we call this the lazy 1031 exchange, because by going into other investments and building up a threshold or a savings account of suspended passive losses, you're able to use that and build it up over time to negate these big capital gains and depreciation recapture that might be coming up for you. Now, if your head is spinning a little bit, don't worry. Like, it took me a couple of years to really, get a grasp of this. Obviously, it becomes a bit of a gaming and it's fun after a while, but you can see the complexity, as I was saying earlier, that this is really your job as the investor, the owner, to really strategize. How do I use my passive losses and my suspending passive losses? When do I activate them to lower my income or not? Again, this is not your CPA's job to do this for you. It's their job to just do your taxes. And it's this strategy that is you need to be in the driver's seat on. So let's talk about the 1031 exchange, which is another option here. However, unless you're looking at a capital gain of a million, $2 million plus, it really doesn't make sense in my opinion. The 1031 exchange, you've got 45 days post the sale of your asset to identify a new property and 180 days to close on it. This is incredibly difficult unless you're somebody who just willy-nilly buying whatever. If you're a sophisticated investor trying to identify really good deals out there, you can't do this in 45 days. You've already identified yourself as a distress buyer. When we actually are selling our apartments, we love when we have a 1031 buyer because number one, we know that they're desperate to close this property within 180 days, and more difficult, identify a property 45 days. We can really screw with the guy once we know this information. And this is why being a 1031 is a very difficult position. Sometimes I would argue, especially if you're going into the next investment where it's a value add, you're probably going to be unloading that property in less than 5 years, less than 10 years, in fact, and you're going to be in the same predicament that you're in the first place. A mistake that I see a lot of investors have done is where they take a big amount of their net worth, they have a property, they 1031 into another property, and it just gets bigger and bigger. I advocate for the complete opposite, where you're taking your net worth and you're breaking it up, diversifying it into smaller and smaller chunks. This is the beauty of syndications and private placements as a passive investor, where you're able to get into these large deals and break up your portfolio into manageable chunks, $50,000, $100,000 chunks, and diversify over dozens and dozens of properties. Now, personally, I've been over 100 plus deals. Now, I don't expect a lot of people to diversify that much, but you see what I'm saying? That's a lot less exposure from a diversification standpoint, allowing you to get into so many different geographic areas and different asset classes outside of real estate. Get into private equity. Whereas if you're 1031ing your exposure there, just in case something happens in that particular market or that particular asset is a real issue. And from a litigation liability standpoint, you don't want to be pooling up all your net worth into smaller silos. Although the silos are big, you're a sitting duck because everybody knows where the money is. That was a 1031 exchange. Not a big fan of it. In certain situations, it might make sense. If you have a complex situation, book an onboarding call, give my opinion on it. Every situation is different. But most cases, this lazy 1031 exchange, when you're going into deals, building up passive losses and offsetting your capital gain is a lot better way of going. There's no timeline there, and you are able to just naturally break up your portfolio into smaller chunks. So you start to build up passive losses to a point where I call this passive loss nirvana. Imagine if you had $1 million of suspended passive losses. You could probably sustain a couple of big sales without paying any money. And the crazy thing is when you redeploy that money into more real estate, what's going to happen? You're going to get even more suspended passive losses. And now you see where the nirvana effect comes into place, where you are somewhat untouchable in terms of taxes at that point.